Oh, sorry.
Are you still kind of an Oklahoma State fan?
Yeah, so I don't really follow sports too much anymore, but still kind of like I root for the Oklahoma teams just because of native, you know. But yeah. So how we doing today, guys? I mean, I think the energy level's down. I did turn down the temperature a little bit. I would rather have you all be cold and awake than warm and asleep. You know, and call me cruel if you want to put that in my evaluations. You are more than welcome to. Like, tried to freeze us out of auditing, yeah, but it's a little bit warm in here. So I'm in a little bit of a mood today. Something happened that the unthinkable happened. Something I didn't think would ever possibly happen in all of my life. I lost to Professor Templeton at trivia.
Oh,
Yeah, yeah. It's just, so DSP had their trivia, their cystic fibrosis trivia night last night, and I was there with Dr. Caden and some of her friends. And we had done a trivia competition over the summer together, and this was at Maxwell's, and we won. We won the whole season, which was pretty cool. But we thought, being high and mighty, was win this competition. We went in there, and Newcomb's trivia focus is a lot different. Fewer questions, but a lot more emphasis on the questions that are asked. And so if you've never done it before, there's 4 questions that have varying point totals that you can specify point totals. But if you know that you got all 4 right, you can double down. All right. And so we get to the first series of questions, and like the first question right off the bat, we're just like, I'm not sure if that's correct. And then the next 3 questions are all right. And it was just like, can't double down because we don't know if we got the right answer. It turns out we didn't. We got the wrong answer. We actually got 2 wrong answers because somebody said one of the people said Annie Hall was Diane Keaton's first film when it's actually The Godfather, which I should have known that, but yeah, I should have. But that was the theme for the rest of the evening, is that there would be a whole bunch of questions and we'd have everything but one correct. And we knew that one was not correct, so we couldn't double down. So we ended up with like one of the lowest point totals in the room. And I'm just really, we were the Smartinis. We finished at 0 because we bet everything for the final category. But let's be honest. I wasn't competing against everybody in the room. I was competing against Professor Templeton because yeah, all the trash that I talk about him, I've got to be better at least at one thing than he is, and that trivia was supposed to be it. Trivia is supposed to be it, but apparently not. Yeah. Everybody dismissed. Yeah. No, we got too much important stuff to do to talk about. I've got to remind you of some important things coming up. One of the most important things coming up Fridays. Everybody know what's on Friday? No, we're canceling class on Friday. That's what it is. No, we have an Excel assignment due on Friday, and this is my last warning because if I warn you on Friday, it's too late. Okay, so please make sure you complete your Excel assignment to submit into submission. Like I've said, it's not a difficult assignment. It is time consuming. I think the people who've submitted already would probably agree with that assessment. It was not difficult, but it took some time to complete. So please make sure you take that seriously. Also, today we've got our executive residence presentation taking place. I believe it's in VH 1000, but I've already heard some really good things about her presentation style, so it's going to be a fun time. I'll be there. Will you be there? No. But if you've not got your professional interaction requirement done, this is the one opportunity. I've been looking at the schedule for Truman about opportunities for other professional interactions within the next week and a half, and I have not seen anything. That doesn't mean they don't exist. I just haven't seen anything. So if you have not got your professional interaction done and you're looking for one and not going to attend today, it's on you to find something. Okay. So that's basically the caution I give you. This may be the last good chance for you to do something like this, or one of the last chances for sure. All right. And with that, we're going to move on to inventory management. So I've alluded to this already. This is not going to be one of our focus chapters. Again, this week is kind of a little bit of an off week. Last week, super intense and rigorous. All right, a lot of information to absorb. I said 40 to 50% of the material is going to come from those chapters. Okay, because it's really important to know those process areas. What we did on Monday, pretty basic and straightforward. What we're going to do today, a little bit more detailed because inventory is a pretty big focus of business operations. So it's going to be a focus of auditing. So we're going to go into a little bit more depth on that. That being said, there will be, I would say maybe 15 to 25% of this would be on the coverage on the exam. Maybe not that much. Yeah, maybe probably the lower end, say 15%. It's going to be more emphasis than what we talked about on Monday, but not substantially more. Okay. So I say 15 to 25%, and then I did the math and said 25% is like the quarter of the exam. It can't possibly be that much. Just as a reminder, there's going to be another table here. Well, this will be our last table that you will need to know for controls. We're not going to do specific tables within the finance and investing sections that we'll do next week. But the combination is that there's going to be questions on revenue controls, purchasing controls, or a combination of human resource and inventory controls. So you'll be responsible for knowing those. So let's go ahead and start off with talking about inventory in the context of due process we've already discussed, okay? So purchasing and revenue, we've already discussed last week. Companies purchase inventory or raw materials for inventory production, and then revenues, companies sell inventory to generate sales revenue. Now, that's not true for all organizations, okay? There may be service organizations that bypass this step, and if that's the case, that's good. We don't have to audit inventory for service organizations. I believe like Cigna Group, a few of you have Cigna Group for companies. They don't have any inventory because they're a service organization. So that would be a situation we bypass that. But 9 times out of 10, this is going to be a very relevant concern for our operations. And it touches areas that we've already talked about. It touches revenue and purchasing. So we need to understand not just the things that are relevant to revenue and purchasing, but kind of the gap in between that's filled by the inventory process. So we're going to talk about it both in context to those process areas, and we're also going to talk about it with respect to how it's a standalone process area on its own. So with respect to documents and records, these are all pretty straightforward. Primarily, these are going to be items that are associated with the manufacturing environment. And we'll talk a little bit about the difference between manufacturing and merchandising environments. There's not a massive distinction here with respect to that, as there is when you talk about merchandise accounting versus manufacturing accounting, the way that we talked about it back in your early accounting classes. There will be a few things that are specific to a manufacturing environment that we will need to consider, but for the most part, our procedures are going to fall the same either way. All right, inventory process. There's the car. So what are the functional areas of the inventory process? Again, just like Monday, these are not particularly well defined because there's some overlap in other process areas, substantial overlap in other process areas. But I do think it's a worthwhile endeavor to talk about these. So let's go ahead and do that. So inventory management, this is basically where we authorize inventory purchase and production. Generally, this is going to be on some sort of rational expectation of what the inventory level should be. And if there's an identified need for inventory, that is where the whole process takes place. Now, note this can actually have triggers within the purchasing process area, which if you remember from AIS, we talked about the nuance behind that. If we're talking about production of inventory or even just purchase of inventory straightforward, we need to actually facilitate that through the purchasing steps because the purchasing process is responsible for acquiring that material for us. But if we're talking about inventory management, to authorize inventory purchases and in a manufacturing environment production, this is going to be the first step. All right. Next is going to be raw materials. Now, keep in mind that we are talking specifically about a manufacturing environment for this one. A retail environment will not have raw materials, but this is going to be the storage of production materials. Then we have our manufacturing, which is going to be our work in process step for the manufacturing of inventory. This is where it's in between being raw materials and being finished goods. This is basically where we're in the process of making it into a good. This is also native to a manufacturing environment, so it's not going to be relevant to a retail environment. And then we have finished goods. This is relevant to both environments because we note that if we're in a retail environment, we buy goods and then we sell those same goods in the same state. Technically speaking, you can make an argument that there is some transformation simply because Walmart would probably buy a big pallet of inventory and then break it down and sell it in individual components. So there is a small transformation, but it's usually a volume transformation is all there is to that. Whereas a manufacturing environment, this is actually the transformation process that takes place, converting some raw materials into finished goods. But finished goods are going to be the same for both. We're going to make sure that we have finished goods, and we understand that that's part of the inventory process, regardless of what our inventory environment is. Then we have cost accounting. Dr. Otero would be so happy right now because I don't ever talk about cost accounting, but I get to talk about it today. So this is basically our record keeping step where we maintain the production and purchase data associated with the inventory environment, an entire branch of accounting just associated with this. And then we have our general ledger and accounting, which are a three-way match. When we talk about accounting, this can be both payables and receivables, though generally speaking, these are going to fall, the accounting treatment is going to fall within it's going to fall within the other process areas. So what I mean by that is that the specific accounts that these are going to touch are going to be that are native to the balance sheet are going to be within purchasing and revenue. So accounts payable, accounts receivable. That's not to say that there's not transactions that take place during the inventory process locally, but those you generally cancel each other out. Like we very rarely see raw materials or work in process inventory hit the balance sheet in most situations, because those are going to be kind of internal account schedules that are held for the organization. So primarily we're going to focus on accounts that are going to be the same one. There may be a few accounts that we have to update. Inventory would obviously be all one of those, because that is going to be something that we save for the balance sheet. And inventory in this context is usually referring to finished goods or the transformation of goods for sale. So that's something we note. All right, so let's go ahead and really quickly, we're going to talk about this last statement here in just a second, but let's go ahead and see if we can identify some segregation of responsibility areas. So we're going to separate those responsibilities out. So let's go ahead and see if we can put the most identification. Again, with the caveat that this is not a clean dissection, that there may be more than one segregation of duties responsibility area that falls within a functional area. But for the most part, I think this is cleaner than it was for what we talked about on Monday. So inventory management, what kind of responsibility would you all assign that one? Give you a hint, you should read within the parentheses. There's probably a big clue there. The authorization, yes, authorizing inventory purchase and production is a big clue there. It's an authorization step. Now, raw materials, manufacturing, and finished goods, these are all inventory. What do we know about inventory? What kind of account is that? It's an asset account. Somebody's gonna answer that question snarky and say, it's an expense account, Dr. Barnes. I'm gonna say, get out. And I say, no, wait, come back. I got to teach you. No. So yeah, it's an asset account. Okay, asset account. So which of our responsibility areas primarily focuses on assets? Custody. Yeah. So these are all custody responsibilities. Keep in mind that these are different phases of inventory. So it's fine that we have some overlap there, but these are all going to be custody areas. Cost accounting, I've already talked about what this is going to be. We'll talk about cost accounting. This is a record keeping step, or as we call it, recording. Okay. Sometimes I will use the term record keeping interchangeably with recording, just as a caution for that. I think I've updated that, but I used to be really fond of to record keeping. And then I said, recording's the same thing, it's just shorter. All right. So yeah, record keeping recording. And then the general ledger accounting, that's basically organizational level record recording, depending on the accounting. This is going to operate the same way that we talked about on Monday. But we can also have three-way matches that occur here as well, depending on what type of reports are generated as part of the inventory acquisition and production process. So it's important to keep in mind that we do want to actually make sure that all of our information is redundant to one another. Now, this is an interesting note. The book actually says that segregation of duties is important for inventory. And everybody can read that and nod and say, yeah, that makes sense to me, Dr. Barnes. And my question is, why? Why is segregation of duties so important for inventory? So segregation of duties is a control. And what is one of our primary concerns about with respect to something like inventory? Let me ask it a different way. Would we say that inventory is a highly liquid asset? So most inventory, not all inventory, okay? It's like if you're a cement mixing company, you're probably saying, well, it's literally liquid, but figuratively speaking, it's not something that I want to put in the back of my car and try to sell to other people. You know, how many bags of cement can you put in your car anyway before the car breaks down? It's like 3. Yeah. Yeah. Depends on what car you have. If you've got a big truck, like most of the people here in Kirksville do, then maybe you can actually pilfer some cement, but that would be a lot more work than it's worth. I remember picking up my first bag of cement when I was like 8 years old. And I was like, there's no reason this should be this heavy. Yeah. So anyway, I'm rambling. So if we talk about the liquidity of inventory, then it's probably prone to fraud. It's probably prone to theft. All right. And one of the easiest ways for fraud to occur is to have overlap in those responsibility areas. So if we know that that somebody's got custody of inventory, we want to make sure that they also don't have recording function responsibility or authorization, because they could basically assign the inventory to themselves. So this is one of those areas that where segregation duties is particularly paramount. So we need to make sure that if there is a responsibility in one area, that there's not a matching responsibility in another functional area here. All right. Let's talk about risk assessment. What should the auditor consider as part of the inherent risk assessment of the inventory process? So one that we've kind of talked about consistently is going to be consistent here, inventory conditions. So competition, new entrants. Now it's important to note here that the same concerns that we talked about for both the purchasing and revenue process are relevant here, because inventory hits both the purchasing and revenue process. So we're not really learning anything new here, because we can talk, if we're talking about competition can be both for materials or for the purchase of the inventory, or for the actual sales of the inventory, subsequent sales in that area. And interestingly note, your competitors may be different individuals or different organizations. The competitors you're selling against may not be buying the exact same materials, but you could have companies that you don't consider competitors in sales that want to acquire the same materials that you do for their production. Easy way to think about this, we think about wood as a material, okay? If you've got a contract for wood, you're competing with any other organization that actually purchases wood in that regard. So something to consider in that context. All right. What about changes in technology? Do we think obsolescence is a big risk for inventory? Let me ask you this, okay? What is this? Has anybody seen one of these before? Nope. God, you're young. Oh, sorry, yeah. So this was my favorite device to have back in like 2000, 2008, 2009. I actually got one of these. This is the BlackBerry phone that I had back in 2008, 2009. I love this thing. Part of the reason why is because it had the individual keys on the device. Like I try to type in on my iPhone, it's just go, yeah, I don't mean to type. Try to hit the space bar and it hits the letter N. And so it happens all the friggin' time because of my big clumsy thumbs. But yeah, so I really like the keys on this thing and I'm so sad they're gone. All right. So if you're going to an audit and you find there's an inventory, a case, like 1,000 Blackberries in a case on a shelf on the wall, you may say, hey, why do you have this inventory? It says, oh, we're planning on selling them in the future. It says, no, you're not. No, you're not. There is no way that you're going to sell these things. Those things have been obsolete longer than I've been alive, according to Michael. All right. So yeah. So yeah, that's a big concern here. We talk about obsolescence. The change in the technology can actually lead to pretty massive fluctuations in the valuation of inventory, which we have to be aware of. And then we talked about fraud risks already. So what is probably our biggest fraud risk with respect to inventory? Probably theft. Yeah, misappropriation of assets. Okay. Now here's a question. Do we have a fraud risk associated with fraudulent financial reporting? Is it possible that a company could manipulate their inventory reporting to also commit fraud on the financial statements? Yeah, it happens all the time. We actually talked about it a little bit, but we think about what happens when you overstate inventory. If you're on a purchasing system, if you overstate your inventory, that understates your cost of goods sold, which if you understate cost of goods sold, it drives up your net income. So yeah, overstatements of inventory are very, very common fraud that occur. That's why we're so critically focused on making sure that it's reported properly. Also, related parties buying and selling is one area that's not necessarily external to these fraud risks, but something that makes sense. Particularly if we're talking about large transactions. I don't want to say like if you're a restaurateur and you're a manager at a restaurant and your family comes in and you give them a 10% discount. I don't want to say that's fraud. Okay, that's totally different. We're talking about big contracts that are outside of arm's reach transactions, whether that's purchasing at a higher price than you normally would or selling at a lower price than you normally would. That would be the bigger concern in this area. All right, talking about controls. I'm sorry, guys. We're still not to substantive strategy yet, but I promise it's coming, okay, next week, okay? But you can hold me to that. We will see it eventually. We're still on a reliance strategy. Does it make sense? Do most organizations have more inventory transactions than they do controls in that area? Yeah, we could have 100 controls in that area and that would get greatly eclipsed by the number of transactions. So the number of transactions is really, really going to limit the amount of work that we do in that area. Not going to completely restrict it, but it's going to limit that work. So we're going to actually use our reliance strategy again, which is good because we're already familiar with that context, which reliance strategy by definition means that we plan and perform tests of controls in this area. And then we're going to set and document our control risk for the inventory management process. All right. So what was our process for the last 3 chapters? There was a table, okay? In case of revenue and purchasing, there were 2 tables each. This is table number 6. This is the last test or the last controls table I'm going to give you. That being said, if you've looked at the tables already, you'd be kind of like, my word, okay? And there's 6 of them, all right? So you have a lot of responsibility in this area, but this is the last one. So I'm not going to go over the table in depth. I'm just going to do one example, but I think it's a relevant example. So let's go ahead and use the example of completeness for inventory. Now you may say, Dr. Barnes, I'm wholly unsatisfied with this because existence occurrence is a primary assertion here. And it's like, yeah, you're probably right. Do you have a question, Michael?
Yeah, what was the table number?
13-5. But we do know that there are multiple relevant assertions with respect to inventory. Have we covered this before? Yeah, we talked a little bit about it back in chapter 5. Remember, we did some testing of sheet to floor to sheet, and we said, does the direction matter? It says yes, the direction does matter because that actually determines what relevant inventory item we're focused or what relevant assertion we're trying to test. So we can actually say that completeness is another relevant assertion. Now, I will not say it's a primary assertion for the same reasons I've said before. Assets and revenues, we tend to be more focused on existence occurrence. Completeness, or sorry, liabilities and expenses, and to a lesser extent, equity, we tend to be more focused on completeness. That does not mean they're exclusive. Those tend to be the primary assertions, but not the only assertions. So we can actually talk about completeness here. So if we're talking about a completeness, completeness is what is the one word that you associate with completeness? Dr. Barnes. Yes, that's 2 words. Okay. What would you associate with completeness? Well, tracing is a good one. I hadn't thought about that one. Okay, what's another word we could associate with completeness? Recording. It's a recording assertion. Okay, so we want to make sure something got recorded. So inventory was received but not recorded. So it comes to the warehouse. It's in our warehouse. It doesn't ever hit our system. That's a problem because we basically don't know that we have for sale. That can actually lead to business process problems. So it's a very relevant risk in this area. What is a control that an organization should probably implement to respond to this? Making sure that receiving reports to match to vendor invoices and purchasing journals. So that's a matching process that we've talked about before. This would be an example of a 3-way match. So receiving report comes in, we're going to actually match those to the vendor invoices and the purchase journal to make sure that the invoice was matched to, and the purchase journal is going to say that it got recorded in the system. What direction are we moving, by the way, here? So yeah, completeness would say that would be doing tracing, so move up. Are we actually moving up here? I hope so. I don't think I've gotten any of these wrong, but you know, might throw one in just to throw you off. I may just say, okay, I'm going to put a vouching one on there and see if anybody catches it. Everybody's just kind of like, oh, yeah, looks good, Dr. Martz. I'm going to say, you liars, you don't know what's going on. No, this is actually correct. Okay, so we're starting with the receiving reports, and we're saying, let's go up to the subsequent document, which is the vendor invoice, and the subsequent entry into the system, which would be the purchase journal. All right, so that's the control. How are we going to test that? Well, what was the word that Michael said? Tracing. We're going to trace a sample of vouchers to the purchase journal. We're going to actually take the voucher packages, which is where everything's recorded for the purchases, and we're going to take those and we're going to see, did these get entered in the system? So the vouchers are created, all the source documents associated with that, we're going to see, did it get recorded in the system? So what do you guys think? Are you happy with this as a series of completeness tests? As a control that relates to completeness and a test that tests that appropriate control? Yes, I hope so. Okay. I've been using this for a really long time. If I'm wrong about this one, I'm going to be really embarrassed. It has happened. I've been wrong on my slides before. It has happened, but I've been teaching it long enough that the redundancy is hopefully there. Okay. Now, with respect to substantive analytical procedures, some areas that we can really heavily focused on are the ones we've talked about already previously. Inventory does have some exposure to substantive analytical procedures, but for the most part, we are not going to develop a lot of models. We're going to rely on trends, and we're going to rely on ratio analysis, sometimes a combination of the two. So comparing raw materials, finished goods, and total inventory turnover to previous years and industry averages, comparing days outstanding and inventory to previous years and industry average, gross profit percentage by product line with quarterly values in previous years and industry data. So gross profit percentage tends to be one that's a really big focus for analytical procedures. And the reason why is because it's a very visible measure that affects outside stakeholders. So this is one that's going to be very ripe for manipulation. So we want to make sure that there's a lot of sensitivity in this area. One thing that's particularly noteworthy is you'll notice that it's not just saying that it's going to compare to previous years, but also to industry data. So think about this. Let's say that all of the other competitors in a particular industry for your audit client have experienced massive increases in cost of goods sold, but your client has actually maintained its gross profit percentage from the previous years. Does that make intuitive sense to you as an auditor? Probably not. You're probably going to say, well, how have their costs go up? How have their costs gone up and yours not? There might be an intuitively sensible explanation. It could be like Southwest Airlines in the 2000s said, we hedged fuel for the next 3 years. We're going to really take a hit in 2008, but for the time being, we're in good shape. All right. Or it could be something like, well, we're committing fraud and we didn't want you to know that. That would be another way that happened. So comparing actual cost of goods sold to budget amounts. So that's going to be another one. We've talked about that with budgeted comparisons. This is going to be that same variance analysis. If big variances, we want to know what the reason is and whether that represents a legitimate change. Comparing standard costs with prior years for considering current cost conditions or current conditions. Standard cost. Did everybody remember standard cost back from 221 and cost accounting? If you don't worry. We've got a bit of a primer here coming up. Okay. And comparing quarterly actual manufacturing overhead costs with quarterly budget or standard manufacturing overhead costs. Okay. So as before, we're going to talk a little bit about audit procedures. So we're going to look at an example of audit procedures, and I want you to tell me what assertion we're testing, okay? So I think this is a little bit of a fun way to kind of reinforce this. And I think these are relatively straightforward, but we'll see. So trace a sample of receiving reports to the inventory records. Hey, we just talked about that, okay? We can do that for control. We can also do it for a substantive test. I love it when we can do multiple things for the same task, okay? So that word trace probably implies what? Completeness, very good. Recompute the mathematical accuracy of a sample of inventory transactions, audit standard costs, or other methods used to price inventory. That word recompute gives away a lot. VAA, remember recomputation is a very powerful test, but it only tests that single assertion. Recomputation test VAA. Examine a sample of inventory checks for a proper classification to expense accounts. Does anybody just read this and say, Dr. Barnes, you're so lazy. You can't fix the word so it doesn't say the assertion in it? And the answer is no. I'm trying to make this as simple as possible. Simple as possible. So what do we got? Classification, yes, classification. Review a sample of time cards before and after period into the appropriate weekly inventory report. What do you guys think on that one? That sounds like cutoff, yeah, and it is cutoff. And then vouch a sample of inventory additions to the receiving reports and purchase requisitions. That's a vouching, so we're moving down. So are we moving down in this one? So we're looking at what was recorded and then just going back to the source documents to make sure everything is consistent with that. So saying it was recorded, does it actually exist? Okay, so we're in good shape here. Let's do another one. That was so much fun. We agree, yeah. Verify that inventory on consignment is held on bill and hold for others, or on bill and hold goods are not included in inventory. So what is that consignment? So we talked about being selling goods on consignment last week and what that meant. And this one, it's saying, what about if we're the consignor? We're the ones who are the, where I guess this is a consignee, excuse me. We're the ones holding goods on the behalf of another organization. So I'm basically like eBay, okay? I'm holding the goods. I know that that's not the way it really works on eBay, but bear with me. I'm holding the goods, but it's not my ownership, okay? So what does that imply? Can I put that information in my financial statements? If I got inventory in my warehouse, but it doesn't actually belong to me, does that go into my balance sheet? No, it's not. I don't have some particular aspect. I don't have ownership of it. So if we're trying to apply ownership, what assertion are we testing here? Rights and obligations. Yes, good. Observe count of physical inventory. Okay, admittedly, this is a really, really bad one. Okay, this is a really, really bad one. I probably should have provided more detail, but there's different things that we can test using this one. The one that I was specifically looking for is existence occurrence. Okay, the reason why will become clear when we look at the rest of these. Obtain a copy of the inventory compilation and agree totals to the general ledger. What do we got there? That's VAA, okay? And then tracing test counts and tag control information in the inventory compilation. That's completeness, yeah, because we have tracing going on here. Also, just as a reminder, I know I do this pretty naturally, but every time you see the word vouch and trace, you should make a mental note. Is it moving in the right direction? Even in my slides, you should probably be very confident that my slides are moving in the correct direction. But if you look at it and say, that doesn't make intuitive sense to me, stop and say, Dr. Barnes, can you explain why that's tracing, why that's vouching? If it makes sense, great. If it doesn't make sense, you need to make sense because this is a critical point for the exam, all right? So tracing and vouching, and I will not deliberately try to mislead you on the exam. I cannot say the same for the book homework. I think they've done some corrections. They've actually fixed some of those, but we may run across an example of where they use tracing for inventory where they've actually been vouching. All right. So what are standard costs? Remember from managerial cost accounting, standard cost? Has everybody got a technical definition for that? Of course not. Of course not. It's been a long time. The good news is I used to teach 221, so I've got my own definition. A standard is a price, cost, or quantity that's expected in normal conditions. A standard cost system is an accounting system that uses standards for product costs. Okay. So we establish what the standard cost is going to be of a particular unit of resource, and that is the cost that we use for measurement purposes. So that's an interesting point. And I think that you probably could have come to that conclusion eventually because everybody remembers their time with Dr. Otero in cost accounting and something that we're fond of talking about is how do we actually value inventory? And this is one of the primary cost drivers, particularly if we're talking about a manufacturing environment, standard cost. The interesting question is not what are standard costs. This is not a cost accounting class, despite how much I talked up Dr. Otero. This is more about how do we audit standard costs? So that starts in the particular junction of this idea of cost accounting. So I'm really fond of giving Dr. Otero a hard time saying cost accounting is really only three things. Does anybody know what the three things that cost accounting, according to my opinion, are? Materials, labor, and overhead. Yes. Yeah. Materials, labor, and overhead. I tell her that's all cost accounting is. And oh, to be honest, that's all it really is. She was outside my room right now. She'd throw something at me. Yeah. Fortunately, she's teaching right now. So I know that. Okay. So how do we understand costs? Let's go ahead and talk about materials. We want to test the quantity and type of materials included in the product and the price of materials. When we talk about variances with respect to standard costs, remember those variances that you had to calculate back in those classes? What were the different types of variances that you could look at? There was the cost variance and the efficiency variances. And that would be something we would focus on very heavily as auditors as well, because we'd want to know any reasons for deviations. It's important to note that these variances both have monetary effects. That's why when you say $1,000 favorable, $1,000 unfavorable, that's why it was stated in those terms, because we want to actually have a focus on how does that affect overall costs. So auditors can look at the same information. Then we have labor. Gather evidence about the type and amount labor needed for the labor production rate. Same ideology is that we're going to be checking the cost and efficiency variances. Then we have overhead. Overhead's a little bit weird, okay? So review the entity's method overhead allocation for reasonableness, compliance with GAAP, and consistency, okay? So anybody read that line and just like, that makes perfect sense. That totally jives with everything I know about cost accounting, Dr. Barnes. Thank you for presenting that. Anybody just got any kind of small qualms or anything about that? Or is everybody just cool with it? What do we know about cost accounting? Does cost accounting have to follow GAAP? No, cost accounting does not have to follow GAAP. So why did I put compliance with GAAP up there? There must be a reason. Dun, dun, dun. So keep in mind that even though the cost accounting rules do not need to follow GAAP, we do not need to have specific record keeping procedures or particular accounting procedures that follow the financial reporting rules with respect to calculation of overhead. The reporting of this information still does need to follow GAAP. So anything that goes to inventory costing information, anything that goes to the cost of inventory flows naturally into the balance sheet. And that balance sheet information does have to follow GAAP presentation rules, okay? So even though we don't have to have standard costing information following GAAP, anything that emanates from the standard cost procedure that's going to get reported in the financial statements, that does need to follow GAAP rules. So management accountants, cost accountants, they're not immune for the rules, okay? As much as they might like to say so, okay? As much as Dr. Dr. Otero likes to be a rebel, she's not that big a rebel, let's be honest, okay? All right, we're gonna talk about one of my least favorite things in the entire world, inventory counts. I had a bad experience with inventory counts, okay? Bad experience with inventory counts. Might say that it made me angry. It made me very angry because I had a bad experience. So what's that?
Just like,
Yeah, so that's right. It's right. So, yeah. Actually, I would say that the whole Templeton thing was more humbling. This is more one of those things. It's like, why do I exist? Okay, that's kind of the where I was at. So a little bit of background. So this is going to kind of dictate some of the things we're going to be talking about here. There has to be very clear distinction of the guidelines and the procedures that go on here. Otherwise, inventory counts turn into a fiasco, and that's basically what happened. I volunteered for an inventory count because I was going back to Oklahoma from Texas, and I was the only one who was anywhere close to the client count site that we needed for the office. So I said, I'll do it. I'm going to be in the area anyway. And so the senior gave me the information. The senior associate gave me the information for the count. I did the count. I compared what the counts should be, and they were dramatically off. So I called the senior. I emailed the senior. I said, I'm not sure what to do, how to do this. You know what the senior told me? Absolutely nothing. They were completely non-responsive for like a period of 3 weeks. And then 3 weeks later, when I was back in Dallas, back from vacation, they said, hey, what happened with that inventory count? I'm like, are you kidding me? And they chewed me out because I didn't follow up properly. I was like, okay. So the big lesson here is all of the things we're about to talk about, the procedures that we have to follow, these are really critical, because if you don't follow these procedures, you're going to end up with a bad time. Okay. You're going to have a bad time. And I definitely had a bad time. I got chewed out for doing the right job. That's all I can say. So what are some things that we need to do? So before beginning an inventory count, auditors should do what? So first of all, ensure no inventory production or movement will occur during the count. This is the same thing we try to say it explicitly, and if it's possible, that's what we go for. If you go into work in auditing the real world, you may encounter an unpleasant situation where on January 1st at 12 a.m., they put you on an inventory observation. And I pray that nobody has to do that. I didn't have to do that. I had to climb on top of a chemical storage tower that was like 100 feet in the air in the middle of winter and do a count that way. That was miserable, but I never had to actually do one on January 1st at 12:01 a.m. Okay. That being said, what is the reason for that? It's because they want to actually capture the inventory amounts right at that point in time. And that's going to usually be a period in time where no production or no sales are occurring. Now, that's not possible for some types of entities. They have to just do our best estimate. Has anybody ever seen an inventory account that occurs at a Walmart store? Boy, it is chaos. It is chaos. You've got a whole bunch of people in red shirts that are scanning things and trying to get to the scan before the customers perk the hold the merchandise off the shelf. And sometimes they'll slap their hands and it's kind of like, don't count that, don't take that. I'm trying to count that. And so customers are trying to reach for shelves. Then the counters are trying to reach shelves. They're trying to do it quickly before too many purchases take place. It is mad. It is mad. So it's not always feasible, but it's going to be as feasible as possible. All right. We also want to make sure the count documentation is properly assigned. And most importantly, ensure that the instructions for the count are clearly understood by the count teams. Now, this is a really important step to note, okay? This is an important distinction. And I think we talked about this back in, in chapter 5. What we are effectively doing as the auditor is we are observing the client's inventory count, okay? This is an observation process. That being said, we can perform test counts on our own. We can actually reperform the tasks that the client does. So the client counts inventory in one area and we count it again. That is a reperformance task. And always, we know from our work in chapter 5, observation by itself is very low reliability, but the reperformance provides high reliability, which is why we do both to run and check. That being said, usually the auditor is not going to count everything the client has. They're going to watch the client count, make sure they're doing a proper routine and doing the proper procedures, and they're going to test count a few of these on their own. Not all items, but maybe a few of the items that they select at random. Some random samples. Okay, so how do we test desertions in an inventory count? So what are the things? So existence occurrence, okay? How do we actually test existence occurrence? This is pretty straightforward. We've talked about how we test existence occurrence already. We compare inventory quantities on record to the observed inventory quantities. Okay, so basically we move from sheet to floor. Does everybody remember sheet to floor from chapter 5? Say no to Dr. Barnes, I wasn't alive back then. God, you all are young. Yeah, so yeah, that's where we're getting really, really young. It's like I don't remember you being here at the beginning of the semester. Yeah, so yeah. All right, so I'm sorry, it was a terrible joke. Anyway, yeah, so we talked about this back in chapter 5. This is one of our assignments back then, and we kind of made the distinction between sheet to floor, floor to sheet. This is sheet to floor, which predictably, if we're talking about completeness, we're talking about floor to sheet. Compare the inventory quantities, observe inventory quantities to the inventory quantities on record. This is not changed. It's the exact same procedure, okay? The direction does matter, but we need to be very, very clear. We understand that when we actually specify the assertion, that we're specifying a direction for testing. What about some other ones? What are some other areas? There's some assertions we can test. Well, there's multiples of these. We talked about this in great detail back in chapter 5. So VAA, we want to observe the condition of inventory that may be obsolete, slow moving, or carried in excess quantities. Now, it's important to note, this is not the only way VAA can be violated for inventory. We talked about a completely different reason that VAA was violated back in chapter 5. Remember that transposition error in recording? That's another example of this, but this is one of the things that's far more prevalent and far more intentional, okay? So if we have items that are obsolete, slow moving, or carried in excess quantities, what is the likelihood that the client is going to realize the amount that they expect to receive for that inventory in the future? Remember those blackberries sitting in the corner? Says, yeah, we're going to sell those for $1,000 a piece. What do we say as auditors? Says, no, you're not. Maybe in fantasy land, okay? Maybe in some dreamed up scenario that you came up with that exists back in 2008, but not today, not in this current day and age. So we do need to be able to understand that this recognition can actually throw off valuation pretty substantially, especially if the client's not willing to make proper adjustments for markdowns on the cost. Another one. We talked about rights and obligations. We talked about holding items of consignment or held on a bill and hold basis. It's interesting to note, we talked about bill and hold and we said that that's a revenue fraud scheme. Is it still possible that we could have bill and hold that could be legitimate? Could we have a client that says, okay, we'll go ahead and we'll pay you for the goods now, but we don't want them shipped until some point in the future? Yes. So what's the rule on bill and hold transactions? You can accept the revenue. You can say it's basically a prepayment. Can you recognize that as an actual revenue in your financials? No, you've not met the performance obligation in order to be able to recognize it. So even though you can recognize it's basically a prepaid revenue would be the way you'd recognize it. But we need to actually have that set aside for whatever that purchase is going to be. So we can still hold it, but we can't have it as revenue, recognized revenue. And then finally, cutoff. Now it's important to note, cutoff in this context, it is still a transactions and event assertion. even though we're testing it through a substantive procedure. Remember, we talked about transactions event assertions are primarily applicable to controls testing. We can actually still do substantive testing in this area, but it's important to note that it's going to be still relevant to transactions and events and not account balances. That being said, we're talking about cutoff information. We want to check the last shipping and receiving documents issued. This is basically the same thing as we did for cutoff for purchasing, just specific to inventory in this area. So we are not really learning anything new in this area. It's just an application of our specific purchasing cutoff test that we did for our homework last Friday, but specific to inventory transactions, not just purchases transactions in general. Now, the question comes up, could we do purchasing transactions in general and still get some assurance in inventory? And the answer is yes. Assuming that we account for all transactions within a period of time in a certain area, it can test both purchases and inventory in that area. That would be a way we could go about that. Same holds true for revenue processes when we talk about sales. All right, we got one more slide, and I got about 10 more minutes or 9 more minutes, but there's a lot on this slide, okay? So some additional considerations. These are not likely to see a lot of coverage on the exam, but I may ask a multiple choice question in here because I do think that they're kind of interesting. So what are some possible causes of book to physical differences? Now, what do I mean by book to physical differences? That means that something that's been recorded versus what's actually on the floor. So what is our recorded amounts in the system or the client's recorded amounts in the system versus what's on the floor? Some possible reasons. Inventory cutoff. If there's any violations of inventory cutoff, then there could be probable recording issues. Unreported scrap or spoilage, okay? If we, especially if we're talking about raw materials transaction or raw materials recording in the manufacturing process, then unreported scrap or spoilage will actually reduce the amount of raw materials that's held on hand if it doesn't get reported properly. So remember, if we have production, oftentimes there's going to be excess materials in production. It's very, very difficult for most production activities to use all of the materials that they have. They have to use some scrap or have to have some spoilage that's going to be left over. So if that doesn't get properly reported, then it's going to have an overstatement of raw materials. And then pilferage or theft. What does pilferage mean? It means theft. I just repeated myself in that slide. Yeah. Actually, I was just copying off of another slide and I said, yeah, theft and theft or theft or theft. That's basically what it is. It's just a fancy term for pilferage or for theft. Yes, that's what I meant to say. Inventory cost methods, FIFO, LIFO, retail, etc. We do have to make sure that they are properly attributed and they are applicable according to GAAP. Okay. We've talked a little bit about this already. Most of these are going to be GAAP approved methods, and those do need to be applicable in that area. If it's not a non-GAAP approved method, then obviously it represents a misstatement, not just a misstatement, but a factual misstatement, because we know exactly what it would be if we talked about it in a context of using a GAAP approved method. Purchase contracts, consignments, pledge or assigned inventory. This is basically could lead to differences that we could identify, especially if there's some sort of malfeasance going on with inventory. So shipment of inventory that did not actually occur, or shipment of inventory that should have occurred that did not take place. If it's going to be a fictitious company, if it's something that's on consignment that's being reported as an actual sale, if it's been pledged, but it's not actually been set aside, all of these could be problematic. This is one of my favorite ones called LIFO liquidation. Okay. Has anybody heard of LIFO liquidation before? So this is an interesting concept. So obviously we're talking about last in, first out. Now, from what you learned back in your accounting classes, what is the general trend of inventory costs over time? Do they go up or go down? Go up. Okay. It's a neat thing about inflation is the prices just go up over time. Yeah. Eventually, you guys are going to be paying $50 for a cheeseburger. Yeah, that's going to be the day right there. Okay, I'm never going to be able to retire because of rising prices. That's going to be the truth. All right, I've just cursed myself. All right, so we know prices go up over time. And what does LIFO say? LIFO is last in, first out. Now, that's not a literal last in, first out. Like we don't take the old hamburger meat and put that and continue keeping that in the freezer and take the new hamburger meat and use that. Okay. Physically speaking, it doesn't match up, but from an accounting perspective, we assume that the most recent materials that are most recent inventory is what's sold the first. Okay, so what happens during a period where I sell more than I produce or more than I purchase? So I've got $1 million in inventory, and I sell $1.2 million of inventory. Okay. So that's probably a bad one. Sorry, $1 million in purchases, but I sell $1.2 million in sales. I'm gonna have to dredge into what I had in my existing inventory at the beginning of the year and round that up. Now that old inventory, the one that's currently sitting on the books, that's not been touched, is that going to be higher or lower price than the current purchase amounts? It's going to be lower because we keep the old stuff in inventory, and that's the stuff that purchased a long time ago. So the last in is first out. So it means that the stuff that's old stays in inventory. So you've got the stuff that's currently sold, and that's kind of what's current market. And then you've got the stuff at much lower cost that gets sold. What is that going to do to cost of goods sold if you sell a whole bunch of your inventory at a much lower cost? So the cost of goods sold is going to go way down. Okay. What do we know about cost of goods sold going down? What happens to income? It goes up. Okay. Now, why is that relevant to auditors? Why is that relevant to auditors? It's like saying, well, that's great. That means our client's going to make a profit, and it means they can pay us more money. And yeah. But what do we need to know? Why do we talk about this? Why is that so important? What do we know about reporting from period to period for auditors? They have responsibility to make sure that there's consistency and comparability. If your client experiences a spike in sales that results in a LIFO liquidation, their income is going to go way up from a previous period. Presumably, their income will go way up. What's going to happen in the subsequent period once they've sold off all that old inventory? Income is going to go way back down. Do we have responsibilities auditors to say this is a one-time event? You should not expect this performance in the future. Yes, we absolutely do. Okay. So LIFO liquidation, it's innocuous because it's just one bullet point here, but there's a lot going on with that. It's an important concept to understand. Purchase or sales to related parties. Let's just a refresher. Okay. What is our responsibility as auditors for related parties? Our primary responsibility is we have to make sure that all related party transactions are properly disclosed in the financial statements. This is required under GAAP, okay? We as auditors have to be enforcement of this. We have to make sure if there's a series of related party transactions, they do get disclosed. They are required to be disclosed under GAAP. More subtly, do we have a responsibility to the stakeholders to make sure that these transactions are reasonable? Yes, and if they're not reasonable, then we may have to add some sort of explicit explanation or even possibly an adverse opinion if we think that's too egregious. If we think it's going to result in a massive misstatement, okay? And then finally, warranty obligations. This one's pretty straightforward. If you sell inventory that has an implicit warranty associated with it, that is part of the cost that needs to be recognized for that inventory. And it can't be understated because that's, again, a requirement under GAAP. One of those things that you learned back in 303. So on that happy note, talking about 303, we're going to call it good for today, and I will see you all on Friday for homework.